this is our result. I think we're not alone when we say it's a bit tougher out there at the moment, particularly the last 6 months. For us, we're very much driven by dividends and income. The Aussie Equities Fund, long only, about $1 billion, just under $1 billion market cap, but our kind of core tenet of this fund is income generation. And so the net operating results, the number we look at most generally, that takes special dividend income out of play for a like-for-like comparison. So we're up marginally there. Our EPS was down a couple of percent, and that's a function of just having a few more shares on issue from DRPs, from a couple of unlisted portfolio acquisitions. But importantly, our dividend was up for the full year, and that's our main goal, as well as generating some capital growth. We've added this slide for the pack this time around as just to kind of generate a few headline numbers. A few people are surprised that we've now been around for 13 years. So Tom Milner, my colleague's been there since then, as the majority of the board. But what we were trying to highlight here is that our turnover is very low. Our expenses are very, very low. We are very competitive and compare well to some of our bigger peers. We've got some good experience, and our yield is holding up quite well at 6.5% on a grossed up basis. That just bottom left there, you can see our franking credit balance is 25 million, and that's going to be important, I think, going forward for us, because this is what we're trying to achieve, is a growing dividend stream. And we haven't been paying out excessive dividends in terms of we haven't been paying out more than we've earned over the last couple of years. And if we go into a period where there is a bit of pressure on dividends from our investing companies, we do have a little bit of a buffer there to hopefully sustain the dividend over the next 12 months. Because the first half is going to be tough. 12 months ago, ANZ hadn't cut, Woolies hadn't cut, Woodside hadn't cut, BHP hadn't cut, and so we're going to have a period coming forward where it's just going to be a little bit tougher on a like-for-like basis. This is our investment process, and there's a lot more work goes into it than this, obviously, but what we're really struggling with at the moment, and I think we're not alone here, is that we have a bit more cash than we normally do at 8%. We normally run at about 4%. Our view is that people invest in BKI to get a Aussie equities exposure, not for us to manage their cash position. But you can see on this slide here, point one is income. As I said, dividends are the important part of our strategy, but we're trying to kind of balance that point one income against valuation. And if you want a good sustainable dividend yield in this market, you've got to kind of pay up for it, because the alternative of going into term deposits is just not palatable for a lot of people. I'll finish I'll just quickly on what we've done over last year. The only new stock we've added to the portfolio is Challenger. We like that on long-term view. We added to that earlier in the year, closer to $7. It's been good since then. In the last couple of months, we've been very quiet. We're a bit more active in February when there's a bit of a pullback. We added to Ramsay, Telstra, Sydney Airports there. In terms of the banks, the only time we've added to the banks over the last 12 months has been when there's been the capital raising events almost a year ago. We have sold out of Bendigo Bank. We're worried about a few issues there I can go into if there's interest. We've trimmed a bit of BHP, and then Rio and Clydesdale were small positions that we've exited. I'll finish on the portfolio in a moment, but one thing I just want to just touch on here is this slide, which kind of shows the proportion of our portfolio and the income it generates. And I think if you're an Aussie equities investor and looking for income, you are in many ways forced to have some exposure to financials if yield is an important part of your strategy. And for us, it is. And the banks we own the banks themselves, we own the four major banks. CommBank, Westpac, and NAB are our preferred. We do own a bit of Bank of Queensland as well. But we've got 28% of our portfolio in the banks, and that's generating 40% of our income. So unless I think you're super bearish on the banks, and we're not, it's very hard for us in BKI trying to generate a dividend stream to sell out of the banks or the financials and go to, as you can see, that bottom right quadrant into cash. So they're kind of the challenges we're having. But just to finish on the portfolio, this is our top 25. We release this every month with our NTA. We try to be very transparent, but we think this is a well-positioned portfolio. We have a good balance, I think, of yield and growth, and I think that balance is really important over the next 12 months. And we have, as I said, 8% cash. So for us, that's about $70 million, and we'll look to put that to work in August to continue to drive some income. But traditionally, we've kind of we've got a list of about a dozen stocks we'd like to add to, but we're just going to wait for the result, I think, and make sure we know what we're buying. But that's us. That's our result for the full year. So thank you for the opportunity to speak again. And